Hey gang, it's Friday, August 21st. Here's the events impacting mortgage rates and why it matters. The Fed may be backing away from another rate hike, but the bond market's telling a very different story, and that matters for mortgage rates. This week was relatively light on economic data, but the headlines were anything but quiet. New and existing home sales both came in below expectations, with higher mortgage rates continuing to keep some buyers on the sidelines. We also got the minutes from the Fed's July meeting. The number of Fed members expecting a possible rate hike in September dropped from 9 to just 3. But the bigger message, the Fed remains very uncertain about where rates are going from here. Now, here's where things get really interesting. The Treasury Department announced plans to start buying longer-term Treasury bonds in September, hoping to push yields lower. And they need to, because the 30-year Treasury bond recently hit its highest level in nearly 20 years. But while the Treasury Department is trying to support bond prices, Fed Chair Kevin Warsh has indicated he wants to reduce the Fed's massive Treasury holdings, selling Treasuries, which would increase yields. In other words, the Treasury and the Fed are pulling in opposite directions, and investors are questioning whether the Treasury's strategy will actually work. At rising oil prices, ongoing geopolitical uncertainty, and a national debt now exceeding $40 trillion, it's no surprise mortgage rates remain under pressure. For now, 30-year mortgage rates are stuck in the high 6% range, which honestly isn't bad considering the current environment we're in. That's it for now. Thanks for listening, and let me know if I can be a resource for any purchase or refinance questions, including reverse mortgages. Have a blessed weekend.